Last week, the Federal Reserve Bank of Dallas said the housing market is showing signs of a brewing U.S. housing bubble. So what does this mean? If you're thinking about buying right now, should this announcement change how you move forward? Do you give up the dream house or the dream of relocation because of what economists are saying? In today's video, I'm going to summarize the economists' reasoning for predicting a bubble, and I'm also going to share the good news in the reports that many headlines don't take into account because, frankly, good news really doesn't sell. This is a really unnerving market, don't you think so? Should I buy? Should I wait? How competitive should you get with your offer if a bubble is really looming? Of course, nobody can really promise you answers to those questions, and a lot of it depends on your specific circumstances. As some of you know, I'm also in the market for a home right now. I didn't buy last year when I should have, simply because I was too busy. Anybody else, raise your hand so we can commiserate. Timothy and I have been working from home for a couple of years now, and our current home is just too small. We really need another office. So the information I'm sharing with you is the same information I'm using to make my decision about my own purchase. The truth is, demand is not going away.
I am here showing my client a home, and I just want you to take a look at all of the people who are lined up to see this property.
People still need to buy houses regardless of what the market is doing. People need a place to live. And in addition to the housing prices rising sharply, now interest rates have risen even more sharply. It's been a little over a year since we saw interest rates of 2.25%. As I'm writing this, the average rate nationally is 4.91%. That means for a $500,000 home, the mortgage payment went from $21.96 a month to $27.92 a month in just 1 year. That is a lot of money. The big question is, how many people will that price out of the market? Will it just decrease the competition, putting a lid on how prices will go? Or will the bubble actually pop, decreasing home values like in the 2008 recession? Because the answer to that question might really change how you move forward. If the rising interest rates simply slow the price increases and your new house only appreciates at X instead of Y, that's one thing. But if there is a bubble that eventually pops and you find yourself upside down on your mortgage, that's another matter entirely. So do we have a bubble? There are three criteria that the Dallas Reserve Bank is looking at when predicting a housing bubble. The first one is the exuberance indicator. The exuberance indicator measures how much people's buying is based on optimism rather than whether it's really a good time to buy a house. And just to be clear, a really good time to buy a house in this context isn't trying to calculate whether you should buy a house or rent, for example. This exuberance metric sets people's expectations of their returns against what the data says should happen in the future. An article published by the Dallas Federal Reserve last week said that the exuberance indicator is currently 115%, and that economists get worried when the number is higher than 95%. But look at this graph from the U.S. Federal Reserve that shows the current exuberance indicator compared to what it has looked like over the past 40 years. You can see that in Q2 of 2021, where this graph ends, exuberance was about at the level of what it was in Q4 of 2000, 7 years before things tanked. They do admit that historically low interest rates are a factor in some of this exuberance. Personally, I think things are going to go a little bit differently this time. Let's look at the second indicator of a bubble, home prices against future rents, and I'll explain what I mean. This is an investment metric. Basically, this is estimating the future payout of the investment an investor is making in the housing market and measuring it against other investment possibilities. The Dallas Fed said this metric is also showing an exuberance that is comparable to the run-up of the last housing boom. For those of you who don't remember the last housing crash, I want to point out a very important distinction. Investors were heavily speculating. Right now, I'm seeing a lot more buy and hold strategies in my market, but back then, investors were buying up large numbers of homes and flipping them at a profit. Regular people who knew very little about investing were also getting into the game. Banks were lending to people who had little to no cash and even very suspect income until the bubble suddenly burst. None of that is happening now. I think the future rents metric tells us that some investors might slow down their buying, potentially finding other more profitable investment opportunities. However, Christina Smallhorn makes a really good point in her latest video about how during times of inflation, investors find safety in hard assets.
You know why? Because all of these big investors are hedging their bets against inflation, and the best way to do that is through real estate.
It remains to be seen to what extent this new economic data scares investors into shifting that strategy. And now let's talk about what I think is the most important metric, the ratio ratio of home prices to disposable income. When we're done with that, I'll explain how it all works together and why it's not as scary as it looks on the surface or as scary as it looks in the headlines. Unlike the previous two metrics, this one does not show evidence of explosiveness. This is why the Dallas Fed said the disposable income metric remains stable. The surge in disposable income is mostly associated with the pandemic-related fiscal and monetary stimulus efforts and reduced household consumption arising from mobility restrictions and lockdowns. Now, I don't know about you, but this is so far removed from reality in my mind. Stimulus efforts, that's why they think people have more money. They gave everyone $600 at the first time and $1,200 the second time. What do they think people can buy with $1,800? I'll tell you what they can buy. It's a month's worth of groceries for a family of 5 with 3 teenagers. Ask me how I know. I think the disposable income stability was due to rising salaries and hourly wages, not government handouts. The fact that $1,800 per person made everyone rich enough to go start buying up $500,000 homes seems, I don't know, a bit far-fetched. What do you think? Do you think the reason so many Americans have cash to spend is because of raises or because of stimulus money or something else? Is there something that I haven't taken into consideration? Tell me in the comments. I also think the distinction is important because if people have more disposable income because of government stimulus money, that was a temporary fix. But if people are truly making more money because of increased salaries, that's more permanent. So, what is going to be the real result of all this exuberance? First, I think it's important to point out that economists have wrongly predicted 148 out of the last 150 recessions. Economics is an academic discipline. Economists like playing with scenarios and possibilities, but the accuracy of those scenarios in the real world are rarely helpful, except to get people really anxious and keep them from sleeping at night. Even though I think the Fed is a bit touched with their explanation about disposable income, I do think their conclusion about how this will play out is right on the money. No pun intended. Actually, it was intended. But listen to what they have to say. Based on present evidence, there is no expectation that fallout from a housing correction would be comparable to the 2007 through 9 global financial crisis in terms of magnitude or macroeconomic gravity. Among other things, household balance sheets appear in better shape, people have more money, and excessive borrowing doesn't appear to be fueling the housing market boom. People are putting down good down payments. Maybe we should be worried because of how often they're wrong. Maybe, but now listen to this bit where they pat themselves on the back. Importantly, experience from the housing bubble in the early 2000s and the subsequent development of advanced tools for early detection and deployment of warning indicators, some illustrated in this analysis, means that market participants, banks, policymakers, and regulators are all better equipped to assess in real time the significance of a housing boom. Thus, they're in a more informed position to react quickly and avoid the most severe negative consequences of a housing correction. I think if we read between the lines just a little bit, what they're saying there is, after the last crash, they developed these tools with all these nifty graphs that we just looked at, which is why they're raising the interest rates to 5% or more. Their graphs said that we've got too much money and they need us to slow down on the spending of it. I think there are two things that will potentially lead to less competition in the real estate market. And genuinely, I think this is a good thing. There is way too much competition right now. We cannot have prices rising $50,000 to $100,000, with each closed transaction. That is not sustainable. However, the two things I'm about to share with you could mean that this crazy competition goes away while properties continue to rise at a more normal rate. If you remember, earlier I noted that economists said that low interest rates had been partially responsible for the high exuberance rate in the purchase market. And of course, that seems perfectly illogical. With these newly increased rates, we should see at least some buyers getting out of the market. Some of this is going to be due to being priced out, but some will also be due to people not thinking it's worth it anymore. They could afford to move, but the increased monthly payments doesn't make it as enticing of an opportunity. And second, the future rents metric means that some investors will decide that real estate isn't the best place to invest their money right now. Some investors are going to decide that they can make more money in other types of investments. If it happens the way I'm saying it will, this will be good news for most people. Sellers likely won't see a drop in home value, so if they need to sell, they should still get a decent price, and buyers will experience less competition in the market and have to take on fewer risks with offers over appraisal and high due diligence deposits. I hope this is the way that it plays out, but again, my crystal ball is still in the shop. If you like this video, you might also like this one about the signs I look for to know if my market has started to shift.